The global energy complex is currently facing a massive, dual-front supply shock. A sudden escalation of geopolitical conflict in the Strait of Hormuz has threatened primary maritime transit routes. This high-stakes crisis coincides precisely with the peak of the United States summer driving season. As a direct result of these converging events, domestic retail gasoline prices have surged past $4 per gallon. For sophisticated investors, this development represents a critical breakout watch for the entire refining sector. Refiners like Valero Energy, ticker VLO, possess a highly resilient economic moat. They process volatile raw crude into vital, finished consumer products that keep the economy moving. Think of this economic moat like a highly specialized toll bridge. No matter how expensive the traffic is, drivers must pay the toll to cross. Consequently, these refiners control the gate to global transportation fuels, allowing them to remain profitable even during volatile macro events. To understand how companies like Marathon Petroleum, ticker MPC, capture value, we must analyze their core operating segments. Midstream logistics assets, pipelines, and downstream refining facilities drive their entire business model. The primary driver of profitability in this segment is the crack spread. The crack spread represents the pricing difference between crude oil and finished fuels. Think of this crack spread as a baker's margin. It is the simple difference between the cost of raw flour and the market price of baked bread. When geopolitical risks disrupt global crude flows, domestic refiners with secure logistics see their competitive advantages multiply. This structural insulation allows them to capture elevated margins while international competitors face crippling shipping bottlenecks. By mastering the spread, these operators convert global chaos into highly predictable cash flows. Recent quarterly results across the downstream energy sector show significant margin expansion. Both Valero, VLO, and Marathon, MPC, have reported robust refining throughput and incredibly high capacity utilization rates. Operational cash flows have surged as international supply disruptions keep domestic product prices elevated. This margin expansion means these companies are earning significantly higher profits on every single barrel of oil they process. It is mathematically identical to a premium restaurant raising its menu prices while its wholesale food costs remain completely flat. Balance sheets are exceptionally liquid, characterized by falling debt-to-equity ratios and massive cash reserves. These financial results demonstrate that downstream operators are successfully insulated from rising raw material costs, translating global supply friction into pure bottom-line growth. Corporate executives are capitalizing on this operational windfall through disciplined capital allocation. Management commentary from major integrated players like ExxonMobil, ticker XOM, emphasizes shareholder returns over risky, speculative production expansion. Instead of drilling expensive new wells that may take years to produce, they are prioritizing aggressive stock buybacks and rising dividend payouts. This strategy represents a highly protective capital moat for equity holders. Think of this capital allocation like a smart homeowner paying off their high-interest mortgage early instead of building an expensive, risky home extension. Executives are signaling that this high-margin environment will persist, and they intend to return excess cash directly to shareholders. This disciplined approach builds massive long-term value for patient equity investors. The broader macroeconomic landscape is currently defined by the unfolding geopolitical crisis in the Strait of Hormuz. This narrow waterway is the world's most critical oil transit choke point. Over 20% of global petroleum liquids pass through this channel on a daily basis. Any disruption there creates immediate, systemic shockwaves throughout global energy markets. Think of this choke point like a narrow, single-lane bridge on a major commercial highway. If one truck stalls on that bridge, traffic instantly backs up for miles. When political tensions flare in Hormuz, shipping insurance rates skyrocket overnight. This cargo premium forces global buyers to scramble for alternative, safer energy sources located in North America. Consequently, domestic refiners are experiencing a massive tailwind as global buyers shift their orders to safer jurisdictions. This shipping crisis is hitting global markets just as the United States summer driving season reaches its absolute peak. Domestic consumer fuel demand is highly seasonal and predictable, yet domestic inventories were already trending far below their 5-year averages. This supply deficit has triggered rapid capital rotation into domestic energy equities. Capital rotation occurs when institutional investors pull money out of overvalued sectors and move it into undervalued, high cash flow industries. Think of capital rotation like passengers on a train moving from a slow, crowded car to a faster, empty express car. Wealth managers are realizing that refiners like Marathon, MPC, are perfectly positioned to capture this massive surge in consumer spending, resulting in a strong reallocation of capital into downstream energy assets. Despite these incredibly strong tailwinds, serious structural risks persist for the refining sector. Cost inflation remains a significant systemic headwind, driven by rising facilities maintenance costs and expensive environmental compliance credits. Additionally, regulatory pressure from federal agencies threatens long-term refining capacity expansion. These systemic risks act as a persistent drag on operational efficiency. Think of these regulatory headwinds like a strong headwind blowing against a long-distance cyclist. The cyclist can still move forward, but they must pedal much harder to maintain their speed. Furthermore, if crude oil prices rise too quickly, it could trigger demand destruction, where consumers simply stop buying fuel because it strains their household budgets. Managing these variables is critical for risk mitigation. Looking forward, the refining sector presents exceptionally clear forward earnings visibility. With global oil transit remaining highly volatile, domestic refiners like VLO will likely sustain elevated capacity utilization rates. Equity analysts are conducting a major valuation reassessment of these critical cash-generating assets. These companies act as vital transition assets that bridge the gap to future energy infrastructure. Think of this positive outlook like owning a highly profitable local utility company during a regional economic boom. The structural demand is locked in, and the entry barriers for new competitors are nearly impossible to overcome. We project highly resilient cash flows and robust yield profiles throughout the remainder of the fiscal year, making these equities strong candidates for defensive portfolios. Navigating volatile energy markets requires institutional-grade data and a highly disciplined analytical framework. As geopolitical tensions continue to reshape global trade routes, tracking capital flows is essential for wealth preservation. We will continue to monitor these critical macroeconomic shifts here at SR Money News. To ensure you never miss our deep dive equity research and systemic risk analyses, subscribe to the channel and turn on all notifications. Position your portfolio with precision, analyze the structural trends, and manage your risk. Thank you for watching SR Money News, your trusted partner for premium financial intelligence and sophisticated market analysis. We will see you in the next market update as we continue to track global capital.